Hey everyone, Couch Investor back to another video for today. So in this video, we're going to go over 5 dividend-paying companies that I think are worth your while. Now, maybe most of you that have dividend-paying companies in your portfolio have these companies as well. Me personally, most of you know, I invest in tech companies, high-growth companies. So yes, sometimes I don't always put the major attention on buying dividend-paying companies, but I do think that it's a must, especially if you're looking for those long-term goals. So the earlier you start, the better. Now, in my personal portfolio, there is Verizon, then 2 tobacco company, Altria Group and BTI, British American Tobacco, John Deere as well. And then, of course, there is Intel that's in the main portfolio, but since that dividend cut, I don't really put it in the dividend-paying portfolio. But I am looking to add 2 extra companies in that portfolio throughout the year, one in the healthcare space, one in the real estate space. Now, both of them will actually feature in this video. I've talked already about one on this channel. Now, of course, do share your list of dividend-paying companies in the comments down below. I'm just picking 5. That doesn't mean that the other companies aren't good. Just for this video, these 5 companies will feature. Now, I'll start with number 1, which is the easiest one to explain, and it's probably the safest one as well. It's Apple. I know, pretty original, right? But I think that if you're building a portfolio, you can even call this the forever dividend portfolio or whatnot. A company that is certainly not going to cut its dividend anytime soon, if ever, right? With the amount of cash that Apple actually has, the amount of cash that it generates each and every quarter, I mean, I doubt they'll cut their dividends. They'll probably raise it each and every time. So, Apple, this is the current picture of the company right now. It is not cheap, especially not if you look at the estimates for this year, right? No growth, actually decelerating. And if you look at their PE, 28.2 times in the next 12 months. So definitely not on the cheapest side. Now, for fiscal year 24 and 25, yes, there is top and bottom line growth there. But overall, you're looking at this from a growth perspective, but definitely also from a stable dividend perspective as well. And don't forget, they are buying back their shares worth billions of dollars because, well, they can. That's also one of the ways that will increase the value of your shares. Now, looking at their dividend profile, for example, you can see here consecutive annual increases, 12 times. Annual growth rate of the dividend. So in the last 5 years, 7.26%. In the last 10 years, close to 9%. Currently, the shareholder yield sits at 3.92%. There is a 0.51% dividend yield and then a over 3% buyback yield. So that's what I've been talking about. You get the dividend, but you certainly get the advantage of buying back their shares in mass. Now, I do want to touch on their latest earnings report, which again wasn't the greatest. We've seen declines across a couple of segments. So when you look at the products that has declined, but services has increased, and of course services higher margins, which is why you see gross margin as a total for this quarter is up year over year. Now, if you look at the segments and the geographies here, we can see that Americas is down, Europe is up, Greater China is up as well, Japan is down, and so is the rest of Asia Pacific. And if you look at the net sales per category, iPhone is down, Mac is down, so is iPad, but wearables and services are up. It's actually a record for services, and I'll touch on a couple of things that they mentioned during the earnings call. So they set an all-time revenue record in services driven by more than 1 billion paid subscriptions. Of course, those subscriptions can be worth just $1 or $2 or $3. I don't know how much the cloud is, but probably not that expensive. Then they said that during the quarter, they returned over $24 billion to shareholders, including $3.8 billion in dividends and equivalents and $18 billion through open market repurchases of 103 million Apple shares. We continue to believe there is great value in our stock and maintain our target of reaching a net cash neutral position over time. Then with regards to the MLS partnership, of course, we have to talk about that. So we could not be happier with how the partnership is going. It's clearly in the early days, but we are beating our expectations in terms of subscribers. And the fact that Messi went to Inter Miami helped us out there a bit. And so we're very excited about it. Well, he went there because Apple helped with the transfer a little bit. Next up, company number 2 is in the real estate sector. It's a pretty young-ish company compared to all the other companies in that segment, and that's VICI. Now, You've probably heard about VICI before, especially if you listen to Joseph Carlson. That's one of the first time I actually heard about this company, and it piqued my interest. So the current state of VICI is this: PE of 12.6 times in the next 12 months. And what's interesting here is that the estimates for fiscal year 2023, if you look at sales, expect sales growth of 36% and EPS growth of 96%. Now, if you look at 2024, sales growth of just 3% and EPS is actually down 6%. But overall, I think growth expectations compared to valuation right now, pretty okay. Now, if you look at their dividend profile, you can see that in the last 3 years that has increased. Annualized growth there is 9.44%, so pretty good. Of course, if you look at the shareholder yield right now, it is being pushed back because of the buyback yield, which is negative 4.34%. But overall, dividend yield of now 5% because of the stock price being down so much is very, very hard to pass on, especially for a company like VICI, who has a pretty good portfolio. Now, VICI also reported earnings not so long ago, so revenue increased 35.5% year over year to just under $900 million. Net income attributable to common stockholders increased year over year to $690 million. That's from a loss of $57.7 million. So again, big increase there. AFFO attributable to common stockholder increased 25.7% year over year to $540.4 million on a per share basis. That increased 11.9% year over year to 54 cents. They announced the acquisition of the real estate Century Casinos for gaming properties in Alberta, Canada, and they also completed the announced Rocky Gap Casino Resort acquisition with Century Casinos. They also expanded their partnership with Canyon Ranch through a preferred equity investment and call rights to acquire Canyon Ranch Tucson and Canyon Ranch Lenox. Now, maybe I'll have to do a complete separate video about VICI because it is a very, very interesting real estate company, especially with their portfolio, very, very fixated on Las Vegas, on the properties on the strip. And I think Vegas is getting revived a little bit, if not a lot. So having a lot of properties there, I think is a pretty good place to be. Now, before I move into the third company, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, I would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And so company number 3, it's a company in the food industry. It's the Golden Arches. It is McDonald's. So McDonald's currently is trading at 24 times PE. It's next 12 months PE actually. Fiscal year 2023 estimates for sales, expected growth 9.6%, EPS 14.45%, and in the next 2 years between 6 and 8% sales and EPS growth. With regards to its dividend payout, so shareholder yield sits at 2.78%, dividend yield at just over 2%, but in the last 10 years, annualized growth there is 7%, in the last 5 years, 8.39%, so pretty good in my opinion. Now, when it comes to their latest earnings report, again, a pretty good report if you ask me. So they had global comparable sales increased 11.7%, reflecting strong comparable sales across all segments. US increased 10.3%. International operated market segment increased 11.9%. International development license market segment increased 14%. Now, consolidated revenue increased 14%. System-wide sales increased 12%. And they say here that digital system-wide sales in our top 6 markets were over $8 billion for the quarter, representing nearly 40% of their system-wide sales. Now, I do want to go over a couple of things that were mentioned during the earnings call. First up, about the visit in China by the CEO. So visiting China truly brought to life the power of a highly digitized economy and our potential for global growth moving forward. With about 90% of our business currently coming through digital channels in that market, it was remarkable to see how the market has forged digital relationship with customers. China is also making tremendous progress in running the restaurants more efficiently, all with the use of data and technology. And this is one of the reasons why you can be, in my opinion, pretty comfortable when it comes to future raises in dividend payouts, because McDonald's is not a company that sits on its hands and doesn't do anything. It embraces technology, and as it embraces technology, the business will be able to be more profitable in the long term. It's all about doing more with less investments required. Then there was a question about how people are spending their money these days. So, as we look at our spend by different sorts of economic cohorts, we are gaining shares. If you look at incomes under $100,000, we're actually doing quite well there, which suggests that we're getting some benefits from trade down from things like full service dining, casual dine, etc. Then if you go a bit lower, you go to the 45,000 and less, our business is performing well there. What we're seeing with that group is we're seeing a little bit of a decrease in order size, but it's being offset by very strong and continued strength in traffic. So I think net, when you look at all of it, there is certainly concern with the US consumer that shows up in their sentiment. And I think with the current macroeconomic environment, that was to be expected. Now, going into company number 4, and by the way, yes, VICI is the real estate company that I want to add to my dividend-paying portfolio, and company number 4 is the healthcare company that also want to add to my dividend-paying portfolio. In this case, it is CVS Health. We covered this once already on this channel for the top stocks to buy, I think the last edition. So this is the current state of CVS. They already reported earnings as well. So we're going to go over the main numbers there. But currently, 8.4 times next 12 months PE for the estimates fiscal year 2023. Sales growth of 8.5%, EPS decreased by 1.24%. But in fiscal year 2024, it's actually upside down. So a decrease in sales, but EPS is increasing by 1.38%. But if you go to fiscal year 2025, that's where things become a bit better according to analysts, not according to the company. So you have sales increasing by 5.31% and EPS growing 11.18%, which I think previously that number sat at $10. Now, if you look at the dividend profile, you look at the dividend yield sits at 3.24%, but the shareholder yield is negative 1.08%, and that's because of the debt paydown yield. Now, overall, purely looking at the dividend, annualized growth there in the last 10 years, 11.54%. The last 5 years, just under 3%. So take that into consideration. The company has been doing some acquisitions. So usually when there is a lot of acquisitions going on, not just with CVS, but every other company, it does take a while for everything to work out, if it does work out, because sometimes you acquire a company, it just doesn't work out at all. And so looking at their latest earnings report, total revenue increased to $88.9 billion. That's up 10.3% year over year. That was very, very surprising to me, actually. GAAP diluted earnings per share of $1.48 and adjusted EPS of $2.21. Now, if you look at the cash generated from operations, that was $13.3 billion. Now, with regards to cash flow projections and the 2 acquisitions, we had some more information during the earnings call. So as I said, they generated $13 billion of operating cash flow and returned more than $3.5 billion to their shareholders. Shifting to their cash flow, we continue to anticipate strong full year 2023 cash flow from operation in the range of $12.5 to $13.5 billion. Now, as for the Signify site, that completed 673,000 in-home evaluation in the quarter, an increase of 16% versus the same period last year, and generated revenue growth of 19%. As for Oak Street, that ended the quarter with 177 centers and 181,000 at-risk lives, increases over the same period last year of approximately 23% and 35% respectively. Oak Street also significantly increased revenue in the quarter, growing 43% compared to the same quarter last year. Now, with regards to Outlook 2024 and 2025, they say here, given the more challenging outlook for 2024 and our desire to set guidance that is achievable with opportunities to outperform, we now believe investors should anchor their initial expectations for their 2024 adjusted EPS to $8.5 to $8.7, essentially flat to our existing 2023 guidance range. As is our convention, this guidance does not assume any prior year result development. Now, given the level of uncertainty for 2024, we also believe investors should no longer rely on our 2025 adjusted EPS target of $10. We will provide more clarity on our longer-term earnings growth outlook at our Investor Day in December. In my opinion, there's more positives than negatives, and especially at the current stock price. There's a lot of bad news priced in my opinion, and not a lot of good news for the future right now. And so we've reached company number 5, and that's Altria Group, ticker symbol MO. This is the current state of the company, PE 8.7 times in the next 12 months. When you look at the analyst estimates for this year, sales growth basically flat, but here yet again, bottom line should be growing quite nicely, 3.17%. Fiscal year 2024, we see a 1.7% growth in sales, 4.26% in EPS. Then when you look at 2025, you see the sales growth there, 1.37%, and EPS 4.77%. Now looking at their dividend profile, you can see here a shareholder yield of, well, double digits, close to 11%. That's because dividend yield currently sits at 8.55%, buyback yield 1.55%, and debt paydown yield 0.86%. In the last 10 years, annualized growth was 7.89%. In the last 5 years, 6.69%. So when it comes here, this is a dividend paying machine. Now, of course, here as well, there is a reason why the stock is down so much. And that's because of the fear that the major population, well, it's not the fear, it's fact-based, right? Less people actually smoke cigarettes. More people use e-cigarettes, vaping, stuff like that. And so that's why you see a lot of those companies, right? Altria, Philip Morris, BTI, they're all going into vaping, e-cigarettes, these pouches, because they know where the trend is going. That said, currently the negative effect of less smokers is being picked up by price hikes. Because believe it or not, addicts, well, they'll pay the extra $1 or $2. And so this is what happened in the latest quarter. So a couple of comments here. We had a solid first half of the year and we continue on our exciting journey towards moving beyond smoking. We completed our acquisition of Enjoy and delivered strong business results, growing adjusted diluted earnings per share by 5% in the first half, and we returned $3.8 billion to shareholders while investing in pursuit of our vision. We look forward to executing our commercial plan for Enjoy in the second half of the year, and we reaffirm our guidance to deliver 2023 full-year adjusted diluted EPS in the range of $4.89 to $5.03. This represents a 1 to 4% growth. Now, with regards to Enjoy, to simplify things, in my opinion, these couple of slides here will explain why they did it. First of all, because of the failed acquisition of Juul, but look, complementary knowledge and capabilities. So on the left, Enjoy is basically this vapor product development. So they have device manufacturing partnerships, international supply chain expertise, and more importantly, FDA approval, especially when it comes to marketing as well. And I think it's one of the only ones in the United States. And then Altria gives it this marketing capabilities, US sales and distributions, a lot of money behind it as well. Why is it important? Well, because of this. This is Enjoy's retail presence. This tiny little box here, nobody really sees it. Now, even if you saw it, this is another issue. So apparently, 95% of these stores, these retail stores, lack complete inventory of the Ace device and 5-pod SKUs, which will obviously change now that it's part of the Altria group. And so these are their targets. For Q3 2023, they will broaden distribution to a total of approximately 43,000 stores. And by the end of 2023, that will reach 70,000 stores, which represents approximately 70% of e-vapor volume and 55% of cigarette volume sold in the United States multi-outlet and convenience channel. So they're definitely not slowing things down. And so here as well, although the stock is hit for a logical reason, I think a lot of risk is already priced in and there's way more reward coming up for long-term investors and especially for dividend investors as well. So that will be it. Those are the 5 companies I wanted to cover today. Of course, do share your companies down in the comments below. Maybe you hold one of these from this video. Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.